Good morning, Dylan Jovine here. Just been emailing with one of our members, Ron from Israel, and I just wanted to talk to you about inflation for a minute. You know, we're talking about it. It got me to think, what makes inflation so damaging and how can you protect your portfolio? So, so there are three things you want to look for when you're dealing in inflationary times. And right now we're going through a transition. It's likely the Fed will be able to get ahead of inflation, but sometimes it just pops out, the horse leaves the barn and so on. So the good news is there's a playbook for dealing during buying stocks during inflationary times. And I'm going to give you the three rules for finding companies during inflationary times. Rule number one, capital spending. You want to focus on companies that have low capital spending requirements. In other words, you don't want to invest in companies that have to build a $5 or $10 billion plant every 5 years or 10 years, Think car manufacturing. The reason is, by the time they build the plant in 5 years, the price is going to be 20% higher, 30% higher. It's going to be much more expensive. So that really chokes and tampers down profits. So avoid companies that have big capital spending requirements. That's rule number one. Rule number two, pricing power, really. Inflation raises prices. So you go to the store and you see that that everything is more expensive. Let's say everything is 3, 4, 5% more expensive than it was the year before. So the second thing you want to look for are companies that have pricing power. I wrote an article, 15, 20 years ago, and I outlined Hershey's. I used the same article in a little lecture I did. Hershey's, the chocolate bar, and as one can tell, I kind of enjoy chocolate. Hershey's has a superpower, a brand name that allows them to raise prices above the inflation rate. So let's say that it cost Hershey 2 or 3% more, let's say 3% more to buy cocoa and make it into chocolate, right? They pay inflation. But they can raise their prices 5% more and people are still going to eat chocolate. So actually, companies with strong brand names and pricing power are actually able to do pretty well during an inflationary environment if they can raise their prices above the inflation rate. So if inflation sends prices 3% higher, but they can charge 5% more, they're doing pretty well. They're actually making more profit. That contrasts with other types of companies like Clorox bleach or Tide or whatever, where you really don't have that. And finally, the third rule about buying companies when you're dealing in an inflationary environment is to avoid companies that have a lot of debt. And this is a good and self-evident rule during all times, really. You want to focus on companies that have 25% debt or less relative to the capital structure, and especially short-term debt. And this is very, very important because if you have, let's say, if you're a $1 billion company and you have $1 billion in debt coming due in the next 3 years, and let's say you finance that at 2.5%, 3.5%, 4% interest. Now, if that debt comes due and the interest rate at that point is 10%, you're going to have to refinance your debt at a much, much higher rate. Because remember, inflation pushes up prices, which pushes up bond yields. So the money you borrowed at 4% 5 years ago, you might have to borrow again at 10% in 5 years. And that really, really, really can lead to what we call capital structure bankruptcies. And really, you got to watch out. There are two types of bankruptcies. There's operating bankruptcy, basically the business can't make a profit. And then there's a capital structure bankruptcy where, the company just has too much debt. They mismanage their capital structure. So again, 3 rules to dealing in an inflationary environment. Number 1, low capital spending. Number 2, pricing power like Hershey's. And number 3, low debt, especially short-term debt. Okay, guys, that's all I have for you today.